There are many reasons to believe the stock market could collapse in the near future. For one thing, stocks are vastly overvalued across the board, and the market will eventually compensate for this. Welcome to our channel, Financial Insights, the place where you are always a little bit smarter and wiser after seeing one of our valuable videos so you can develop your financial knowledge. Don't forget to press the like button and subscribe to our channel so we can make even more financial content. To explain why the stock market is unexpectedly throwing a tantrum and how this may significantly affect how high or low rates can go, we must first define what a bond is. A bond is a form of lending or borrowing money. Corporations and governments will allow you to lend them money and they will repay you with interest. In this situation, the Treasury bond is the bond that we are concerned about and is the issue that everyone is worried about. These are government-issued bonds that allow you to lend them money for whatever purpose they want, and they will repay you plus interest. And, what's more surprising, the interest rate they pay you is completely dictated by supply and demand. See, the government isn't going around saying, "Oh, I'll pay you 5% interest if you give me some of those sweet tendies come one, come off." Instead, certain treasury bonds are auctioned, and the market determines how much interest they pay. The government says, "Here's something worth $100 to someone who wants to lend me money for 30 days, who wants to make a bid." The first lender says, "I'll give you 95 for that," which will be more than a 5% return. "Wait," says the second investor, "I'll pay you $98 for that. That's a 2% return on investment." "That's weak," says the third investor. "For that, I'll pay you $99. I'm fine with making 1%. And the fourth investor says, "Get out of here. I just want a secure location to store my funds. I'll pay 99.50 cents for it, and I'll get a half percentage point of interest." The government then declares the property to be sold, and that is how bond yields, which dictate how much interest is charged, are valued in the market. If, on the other hand, the government goes to auction and no one wants to purchase them, the interest rate would have to rise to encourage more people to buy them. It's the same as if we put $100 in a cap up for sale with the stipulation that you pay for it today. However, you will not get this $100 for the next 12 months. So, if you can have it for $50, it's a no-brainer because you'll have doubled your money in a year. However, paying $99 for $100 in cash is unlikely to make sense because inflation will eat away at the money over that period, and by the time you collect it, it will be worth less than what you paid. So, now that you know how this works, let's talk about why people are so anxious about it and why it could lead to a stock market crash. All of this can be traced back to one ominous word: inflation. Remember when your grandparents would sit you down and remind you about how a nickel movie used to cost, or how a brand new car used to cost $1,000? That, sadly, no longer exists, owing to inflation. This is the pace at which the cost of goods and services rises over time, lowering your capital's future value. It's why in 1950, a house was valued at $7,400. In 1970, a dozen eggs cost 62 cents, and a gallon of gas cost $1.19. It's commonly believed that the more money printed in our economy, the lower the value of existing money and the higher the cost of buying the same item. But something interesting has happened in the last 40 years or so. Since the early 1980s, the rate of inflation has been steadily declining. Inflation has failed to even hit 2% in recent months. So, what's the issue? Because that should be a positive thing, right? Investors are now concerned that there will be inflation, perhaps even more than normal, as a result of trillions of dollars of new money being poured into the economy that has yet to be spent because the economy has been temporarily shut down. As a result, those investors are not buying 10 to 30-year treasury yields because why would they want to lend their money? It's totally illogical. Of course, by this point, you're probably thinking, okay, we get it. Just don't buy those 10 to 30-year treasury yields any longer. Solve the puzzle of why we should care for him at all. When investors don't go out and purchase those treasury bonds, it'll all start to fall into place. The interest rate on such bonds must rise in order to entice people to purchase them. These rates have risen from 1.6% to 2.5% since January 1st. That might not seem like a big deal until you know that virtually everything is determined by how much those treasury yields cost. If those yields rise, mortgages may become more costly, with higher margin rates and higher interest rates. Simply put, all debt comes more costly when investors refrain from purchasing treasury bonds because they expect inflation would be higher than the yield on such bonds. And now, of course, the moment you've been waiting for. As interest rates rise, corporate debt becomes more expensive to service, resulting in reduced profit margins and lower stock prices. Furthermore, the valuation of growth stocks, such as tech, solar, and EV, is extremely vulnerable to interest rate increases. This is due to the fact that such businesses are known for their future growth potential. When interest rates are relatively low, investors can afford to pay a higher price for stocks because they aren't losing as much money as they would be if they invested in a treasury bond. As interest rates rise, however, those treasury bonds begin to look very attractive. When debt becomes more expensive to service, tech stocks fall in value, dragging the stock market down with them. So, the big question now is whether interest rates will continue to rise and whether this will cause the market to fall. Well, it depends on who you listen to. On the one hand, we have Jerome Powell, the chairman of the Federal Reserve. He has stated several times that he has no intention of raising short-term interest rates and they will remain at 0%. He also predicted an initial increase in inflation as people eventually leave their homes to go on vacations, shop, eat at restaurants, and otherwise spend their money in an attempt to flush it out of their systems. But in the long run, we say inflation isn't a problem and that people shouldn't be worried about it. He also warns that over the next few months, we'll see higher than normal inflation, but only because of the way inflation metrics are measured. It is usually analyzed on a year-over-year basis, in which we track the price of an index from the previous year and equate it to the current year's price. However, since the shutdown caused a temporary anomaly of low inflation in March and April 2020, we can calculate it again exactly 1 year later. It will seem much higher than it is. As a consequence, he tells us not to stress and that all will be perfect. Investors, on the other hand, do not believe this and believe that inflation will be much higher and much faster than the Fed predicts. As a result, they will be forced to lift interest rates even sooner than they expect. However, the expectation comes at a price, and that price is higher interest rates. Mortgage rates have risen sharply in recent weeks. In fact, this is the 5th week in a row that rates have risen, and they've just hit their highest levels in 9 months. The good news is that, traditionally, mortgage rates are still unbelievably strong. However, the real question is how quickly those rates begin to rise again and whether or not the momentum would continue to push us higher. Now, let's see where we go from here. The biggest risk for investors isn't that interest rates would increase because, let's face it, we all expected them to rise at some point. Instead, the concern is how rapidly they're rising and how this could shock the economy before it has a chance to adapt properly. So, essentially, even though you have no idea what's going on when it comes to this, you should be aware that large investors believe we will see higher inflation than predicted, which has pushed down bond prices and rising bond yields. As bond yields rise, interest rates become more costly and the stock market falls. What's going on right now is that investors are concerned about bond yields, and there might be an overreaction to that fear that inflation will quickly spiral out of control. But whether or not that is the case remains to be seen, and since inflation data is released every month, we'll most likely have to wait until the summer to find out what's going on. We also wouldn't be worried about a 10 to 15 percentage point swing in the stock market. That, we believe, is simply the market adapting to what could happen. Keep buying in. That's the only thing you can do. It's the reality, and it's often helpful to be reminded that what we see right now isn't unusual. It makes no difference if you lose money in the short term. You keep buying and keeping, and things will work out in the long run. Type stock market in the comments below after seeing this video. Thank you for watching. Follow us on Instagram and make sure to subscribe and check out our other valuable videos. See you soon at Financial Insights.